Nippon Paint Flex 400 waterproofs concrete permanently and effectively from Nippon Paint.
The Monetary Policy Board at its meeting held yesterday decided to keep the policy interest rates unchanged.
The central bank yesterday sounded more emphatic that a further decline in lending interest rates is warranted, especially for new loans. The average weighted new lending rate is around 13.5% as against the average weighted prime lending rate of 9.68%. The latest assertion that lending rates should come down further follows the Monetary Policy Board of the CBSL yesterday, keeping policy rates unchanged in its May review. Between October last year and March this year, policy rates have been reduced by 250 basis points. In its statement, the CBSL said the overall market interest rate structure has adjusted downwards in response to the monetary policy easing measures implemented thus far. The yields on government securities continued to decline, further aligning with the current level of policy interest rates. With the decline in average deposit interest rates in the banking sector in recent months, along with the moderation of benchmark interest rates, further space has been created for overall lending interest rates to adjust downwards in the period ahead, CBSL said.
Of the interest rates, we observe that there has been an overall reduction in the market interest rate structure, which includes benchmark interest rates, deposit rates, as well as lending rates. In the table, we have shown some key interest rates and their changes during last year and this year up to now. We could see that there has been notable reductions in all of these interest rates since June last year, in line with the commencement of easing monetary policy stance adopted by the central bank. However, we see that there is further space available for market lending rates to adjust downward further. This is in line with the recent large reduction observed in the benchmark interest rates, especially the prime lending rate and government securities yield, and also a notable reduction observed in the deposit rates in the recent months. So in line with that, we think that there is space available for financial institutions to reduce the lending interest rates in the upcoming period. In addition to that, even though the weighted average rates have broadly come down, we see some elevated level of interest rates for some selected lending products, and we expect the financial institutions to appropriately adjust the lending rates on these the selected retail products as well. So the chart shows some selected interest rates. The first two charts are for the benchmark interest rate, prime lending rate, and the 91-day treasury bill rate. And the next two charts for the new deposit rate and new lending rates. The red bar shows the increase in these rates from April 2022. That means before the significant tightening adopted by the central bank, and up to the peak levels they have recorded during 2022 or 2023. And the green line shows their reduction compared to the peak level up to now. So you can clearly see that the benchmark interest rate, like prime lending rate and the 91-day treasury bill rates, the reduction has been higher than their peak levels observed during the tightening cycle. And the new deposit rates are almost in line with the adjustment happened during the tightening cycle. Now in the easing cycle also, it has almost touched the same level. However, there is still space available for new lending rates to adjust further compared to the level they peaked. With regard to credit to the private sector, we observe that even though there has been some notable expansion in credit during latter part of 2023, so far during this year, the expansion has been sluggish. We see only a small expansion in credit, private sector credit during 2024. And we expect that with the anticipated reduction in overall lending rates as well as the retail interest rates, we expect that there will be a sustained recovery in private sector credit. So that will support the recovery of economic activity.
Governor, in your opinion, what's the reason that the banks are very slow to reduce the interest rates? lending rates, given the fact that their cost of funds are relatively low. And every monetary policy review keeps saying that there is room for further reduction, but are you being ineffective in terms of getting to the desired level?
No, I think we have to appreciate the fact that if you look at the charts, it has been coming down significantly, but still not aligned with our policy rates and normal monetary policy cycles. I think if you look at the monetary policy cycles, in a cycle of policy easing, transmission happens with a time lag. That's where we have seen some of the rates have basically policy have been transmitted to the policy rates faster. This is a usual kind of transition process, and the transmission happens, takes a longer time, especially when it comes to market lending rates. The private sector, that's one of the reasons I think is that market lending by the banks to the private sector depends on not only the policy rate reductions but also several other factors like demand for credit by the private sector is one reason. Other one is some of the other risk factors they price in when they are lending, and also I think earlier there was a claim that the repricing deposits are the one of the reasons why they are so low, but I think what we can see now, repricing of deposits has already happened, so deposit rates have been adjusted. I think they have still room. We are emphasizing that we would like to see the transmission faster, especially what we see usually in the easing cycles, rates, market rates downward is a little more rigid than in the upward cycle. That if you look at even this chart, you can see upward movement has moved faster in all the rates, but downward has been gradual. So we hope that this is why we thought we give some more time for that race to adjust. I think it's not, I don't say this ineffective. Well, banks need to obviously it's also the private sector demand and also their ability and go and bargain or negotiate for a better prices is also important. Especially we are monitoring the new lending rates. It's hovering around about 12, I think 12.5 like. I think that you can see the chart is the highest. So new lending will have to happen at much lower rates, but lending already happened, adjustment is slower. But this is a little bit of a concern that new lending still happening at a relatively high rate, is that we are emphasizing new lending should happen close to the other market rates. So we hope that will happen soon. This one factor is that prime lending actually has adjusted. It reflects the risk appetite and pricing the risk by the banks. So they have shorter term prime customers are already benefiting from lower rates, but the other risk factors are the ones who are paying a little high price now.
Is there a way to sort of release how much of PLR is being lent on a weekly or monthly basis? Because you keep flagging off, but I don't know how much of credit is being lent and to what sectors.
Are we publishing that information? Volume-wise we don't publish, but I think we are seeing the volumes have been also going up recently when with rates coming down. For example, when prime rates was about 20%, volumes, weekly volumes are much lower. But volumes have been, I think, average volumes about 6 billion weekly average volumes now. It's much higher rates, much higher volumes also happening, but those are much shorter term borrowings by the prime customers. But volumes are going up, and that's why I think, and also the fact that still we don't see, even if you look at price to the credit, it's not picking up as much as we thought is. I think people probably are not still willing to borrow on a bit longer term, still in kind of a working capital requirements being financed through short-term borrowing. That's our observation for the time being.
For more latest news, subscribe to FTTV.